Today on the Real Estate Unlock podcast, we have a special guest by the name of Reese Ryan with Wealth Artistry. He specializes in buying properties out of state as well as uncommon banking methods. He's managed to buy all his rental properties without bank approval, using his own credit score, or any of them being reported to the credit business bureaus. Today, we'll learn a little bit about him and his journey and go over a very interesting method he utilizes called equity acceleration. Now, with that being said, how are things rolling for you today, Ryan?
Oh, Joseph, this is great, man. I'm super stoked to get to spend some time with you and get a little bit about my background and some of the things that you and I have been discussing in some of my small groups and a lot of the things that are within Wealth Artistry. So Mondays is just the start of my week, just like everybody else. But I'm really looking forward to taking a little scouting trip out to doing some market research and going looking at some of the properties that you're looking at doing as well. So it's shaping up to being a killer week.
I agree, man. I agree. I can't wait for that Dallas trip, man. It's going to be
Yeah,
awesome. And you're
stoked.
also going out to San Antonio, right?
Yep. So again, we'll get into it, but over the last year or so, I've been really making my way out of being being an employee to being an entrepreneur, and part of that is developing wealth artistry. So I've been growing my small member groups as well as my clients across the nation. So I've got a handful of people that are participating, playing the game with me out in San Antonio, as well as Dallas, and this is just the first of many travels that I'll be having this upcoming year. So.
Awesome. Awesome, brother.
Yeah.
So, okay, man. So let's kick it off, man. What's going on in Ryan's world, man? Tell us a little bit about yourself, where you grew up, and where you're
Mhm.
currently located, and what you do for work.
Yeah, you got it. So I think my background, first and foremost, is I grew up in the island, so I'm from Hawaii. Currently out in LA, outside of Santa Monica. Been here for the last few years, but I think where I'm kind of shaping things up is looking at kind of relocating to possibly Texas or maybe Nevada. I'm looking at my options as far as, again, the utility of being able to do what I do best, whether that's online consulting or doing real estate remotely, buying properties out of state, et cetera. So um, but I think my background really comes from the hospitality background, luxury fine dining, customer service. I grew up in that space. So um, for a lot of what I do is basically fine dining, really working at nice steakhouses, Beverly Hills, luxury hotels. That's been kind of like my background in my vocation, right? So being able to work on my craft, my profession, my career, if you will. And so the last couple years or so, and I think this is a testament of our connection, is really being able to be a high income professional and then be able to replace some of your income, right? Really be able to build wealth, create wealth, and then ultimately leave wealth, right? Because one of the ideas I've been really chewing on in just my own upbringing and the way that I was raised is the haves and have nots, and so it's something to make lots of money, but then be able to pass it on, right? Be a good steward. And that's really where, for me, and what I do with wealth artistry is helping people keep more of their money, right? Pay less in interest, pay less in taxes, be able to have the proper structure, whether that's with your business credit or legal or, all of the above. So I take a lot of my background working in restaurants and apply that to creating experiences for myself, whether that's traveling, whether that's taking those calculated risks, being self-employed, investing in real estate, owning assets, taking some of those chances to the point where now week in, week out, we're looking at playing the game, right? What's the one thing I want to accomplish this week? So
Interesting, man. Interesting. You mentioned fine dining.
mhm.
How does one transition from fine dining to real estate investing, man? Show us that journey and what's kind of motivated you to get started.
Right. And I think that might be the $14 million question right there, right? Because um,
I think you
what
underestimated it. It might be a little more than 14 million.
but I think the genesis, the thought of how does one go from waiting on tables, serving tables, to owning rental properties, having your own business, playing the business credit game, et cetera, accelerating your equity, graduating from being debt free. It's the very first seed idea that kind of came to my mind when I was in my early 20s was like, I just want to own stuff. Like, I don't see myself as a doctor. I don't see myself as a lawyer. I don't see myself as like really working for someone else. And I definitely have, I think, a natural bias or an inclination to being more creative and maybe a healthy um, disrespect for authority. I like to think for myself. I'm self-taught, so a lot of the premise of me working in fine dining, even at an early age, not really fitting into college, and just really taking a stock of what is my life going to look like. I think part of my story is, I love my dad to death, but the he really kind of pointed me in the right direction of, work hard, get a good job, buy a house, have a happy life, right? And that's more of hope than a plan. And so, once I was kind of introduced to serving and working in the restaurant, I saw a lot of lifelong employees, right? Managers, bartenders, people that are kind of outlived their career, but they really have limited options. So from in my early, maybe more my mid 20s or so, I really took it serious of looking at contributing to my retirement account, looking at buying property, and I kind of just had this idea of just I'll just buy one house a year, right? And partly being priced out of the Hawaii market and even the California market as well. I'm very fortunate to have family friends really point me in the right direction. So I started buying cheap little ugly houses in central Illinois, and the rest is kind of history, right? So as I went through that first one, I had to choose between a new set of rims and tires for my truck, right? Like really just the toys and this is I work so hard, I want to upgrade my truck versus thankfully my auntie, she basically said, well, go use that money as a down payment, go buy a rental property, and so have that pay for itself and it'll appreciate. And there was a bunch of terms I didn't even know at the beginning, but now on the other side of it, as this financial big brother, I'm pointing people in the right direction and really passing on some of these concepts of what's a HUD, what is a DSCR loan, or like what are some of these technicals that if you're just working a 9 to 5, you might not be privy to. And I think as I kind of get to the point where I'm at today, I really do delineate between being an investor versus an owner, right? So a lot of the things I do in just my general agreements to myself or striving for excellence, it really is taking ownership, taking responsibility. And that particularly is how I look at my portfolio and having workforce housing and really being able to kind of share that with more people. So
Yeah, man, I'm curious. How old were you when you decided to make that when your aunt was giving you that advice?
if I'm not mistaken, I think that might have been 26, 27-ish, maybe a little bit older than that. Honestly, I do need to go back and kind of like uh, dialogue, like the actual like origin story. But it was definitely in my mid to later 20s. I had kind of run through the college years. I kind of went through kind of the party lifestyle and really just kind of living my best life to the point where I'm like, oh, I'm starting to connect dots. Like this isn't going to be forever, right? I have to start making some of these financial moves. So again, a lot of my clients and my members in my small group are kind of coming to that age of 27, 28 of like, well, is there more to this? Is like, what else do I need to do, right? So it basically started with I'll just buy one house a year. I think it was 26 or 27 if I'm not mistaken. And I bought my first four houses through that. And then we'll get into it here in a little bit, but I started being introduced to some of these uncommon banking strategies and really looking at the financial side of the equation. And so for me, kind of getting a little bit more self-esteem and clarity and definition of where do I fit into the grand scheme of things, I love the financial side of the equation. I'm not particularly concerned about paint schemes or swinging the hammer or the square footage or like the tangible property side of the equation.
Right.
I love the puzzle. I love the creative acquisition. We can kind of bring up the parlay method here in a minute, but being able to look at the finance side, really being able to use your leverage, your credit, so that you can really have a lot more options. So that's where I kind of have come to my expertise, where I took kind of a pivot, right? So once I was introduced to equity acceleration, I took a 30-year mortgage and paid it off in about 5 years. So I had to choose, do I just buy another door and just keep playing the game, or can I really adapt the strategy and implement that for myself? So I had limited resources at the time, and even now to a degree, but I have more options. But kind of the origin or the backstory was, yeah, I'm just going to buy a couple houses one at a time. And then I was introduced to new concepts. I was like, oh, let me roll that into what I'm doing today and really making the most of it. So at this point, and maybe I'm getting a little ahead of myself, but the first two houses I bought were with seller financing,
Okay.
right? The third and fourth house was with private money. And then from that point on, I really started taking equity acceleration to heart. And the bulk of that lift was done in about 3 years of overfunding my life insurance policy, as well as combining that with equity acceleration, where from that point on, now I've got a banking relationship with a local banker, and I have properties that are free and clear. And I'm like, well, let me get a HELOC. And now that I have the HELOC, I can basically continue to draw the money out and then go buy my next rental property. And as the equity grows or depreciates, I can pull that equity out and apply it to the next property I'm going to buy in Kansas or Dallas or San Antonio. So wherever I choose to go. So,
Right. I gotta say, man, that's impressive, because I was that guy that actually went and bought the rims and the sound
mhm,
system, like I didn't have really no one to kind of like properly guide me going like early on. And we would make money and then we would spend it as fast as we would make
right.
it, right? So
Yeah.
like I really wish I had that mindset early on
Hmm.
getting this money and investing it into something, whatever it be, but obviously real estate's the topic, right? But it's good that you kind of had that guidance early on, and you seems like you kind of made some moves early on. That's impressive, man. you
Yeah, and,
know
and I would say again, like to me, it doesn't matter how big the move is. Again, me positioning myself as a financial big brother, right? Really being able to have that servant's heart and look out for other people. Like, hey, Joseph, I love who you are as a person. Let me jump in your corner. Let me point you in the right
right,
direction. Let's have some conversations. Let's talk about this stuff. Has really come from a point of me just figuring out how to be consistent just for myself, right? Just
right,
because I think there's a lot of people that are gurus or mentors or personalities that are looking to take people's money or what's in it for themselves and have a lavish lifestyle. And I think proportionally, there's a lot of people that are looking for guidance and don't know where to go, right? And so where I kind of find myself, it's, well, there's not a real big secret to success. You just got to show up and do the work, right? I
right,
don't know where it came from, but part of my, I guess, morals or ethics is all I really have in this life is my word and my ability to work hard. That's all I really have, right? I can get all the extra, distractions and all these extra things, but what it really comes down to is really just setting your mind to something and really being able to stay consistent. I wish more people would just really appreciate what it really takes versus kind of the glitzy, the glamorous. Oh, I saw it on TikTok or I saw a podcast or whatever. But it's like really having a sober look at what it really takes to be successful, right? Really put in the hours, making some sacrifices. I know we talk about it in our live calls of, be, do, have. Who are you? What are you willing to do in exchange for what you want? And that's really my playbook. That's my secret sauce. It's just refining who I am as a person, working harder on myself than I do at my job, getting clarity, defining what it is I want. Hey, I want to buy one house a year. Hey, I want to establish my personal credit. Hey, I want to accelerate my equity. Hey, I want to, XYZ, and just go do it, right? I want to take a scouting trip out to Dallas. All right, we're going to do it, right? So again, I think there's a healthy amount for myself of being a practitioner, right? Really being able to take to heart, these are the things that I do as the principal. I'm the one that's in charge of my life. I'm not, maybe for another time, but again, there's really this counter argument of learned helplessness, right? I'm not a victim. Like, it's my life is happening for me, not against me. So that's really shaped a lot of who I am as a person.
I think a lot of people, they kind of like overthink it,
Yeah.
like everybody wants to learn everything at once, like I
Mhm.
got to read all these books, I got to watch all these videos, and then like the
True.
most important thing here is to just take action, right?
Yeah.
It's like make mistakes, create problems and learn from them. And that's the
Right.
biggest thing from here, because that's what I learned personally, even at my job, like I'm an engineer, and
Mm.
it's like when I went to school, I went to a union school, right? And
Right.
it was like I was learning, but most of the things that I learned were on the job, like, breaking things and then learning how to
Yeah.
fix them, or like breaking something, not know how to do it, and then just
Mhm.
going asking somebody, hey, give me advice,
Yeah.
or what can I do here to, fix this. But I think it applies the same concept to real estate. Would you agree?
Oh, absolutely. And again, I think that's really one of my strongest suits is, and this is something that I've had to cultivate through working in the restaurant. Sometimes you get triple sat, quadruple sat. Sometimes the kitchen's going down. Sometimes people call out. And so again, I've had to learn how to ask for help. I cannot overstress that. And I think that's especially true in the real estate industry because whether you're house hacking and doing the Burr method and you're just owner occupying, or you're self managing, you're being your own landlord, or you're buying properties out of states, whether you're representing buyers and sellers as an agent, whether you're, wholesaling, whether, whatever the case may be, there's a lot of different perspectives. So again, we like to have kind of different what's the word terminologies and equations like the percentage rules and things like that to make it more clear, but there's so many different interpretations of where we can kind of play in real estate. Whether you want to buy notes, you want to do tax deeds, you want to do fix and flip, you want to buy and hold, short-term rental, like the list goes on and on and on. So again, your flavor of real estate can be very, very confusing. Oh, well, the guy said this about that, but it might be a new law that has just changed that basically says, well, that's illegal or you're not allowed to do that anymore. So to me, I think it's really crucial to one, be able to ask for help, really being able to seek out, better questions, seek out advice. I reserve the ability to mentor people in my life. Um, but I think there is something to be said about finding people that can teach you, that can train you, that could really show you, if you can follow instructions, this is the way to go do it. Right. So,
I couldn't agree more, man. And like you strike me as someone that reads quite a bit in his spare time. I
mm,
know that bookshelf's fully stocked, but give
yeah.
me one real estate book, just one that had the biggest impact on your investment strategies and mindset.
Got you. We can definitely answer that. Did lose you on the video though. Got you on the sound. But most pivotal book, I think, probably have to go to Think and Grow Rich. A lot of what I'm doing today is reflecting on the be do have concept, right? And so part of it is really being able to what I look in a framework of realizing, visualizing, actualizing, and then materializing, right? So again, not to offend anyone in the secret camp or the law of attraction or manifestation. A lot of the things that are happening for me today are because I'm materializing these things in my life, right? So again, there is, frequencies and vibrations and resonance and, are you positive? Are you negative? Are you focused on problems? Are you looking at solutions? A lot of these things really come into play for me by thinking and growing rich, right? I sincerely wish for you to be a multimillionaire, to achieve all of your accomplishments, not so that you can have $1 million in the bank, but who you need to become in order to have that, right? So again, the personal growth, the professional development, these are tenets in my life. And so I think Think and Grow Rich is fundamental as far as, again, starting the process to, again, not just be in real estate and not just be an entrepreneur, but to create wealth. And then through that, I'll kind of throw out honorable mention. The Cash Flow Quadrant by Robert Kiyosaki is a wonderful book on looking at how to use other people's resources, other people's time, leverage, credit, things like that. And then another one that I really kind of operate between, it's The Millionaire Next Door, right? Having some discretion, having diligence, kind of living within your means, really being able to have discipline, self-control, but at the same time not be stuck in a certain camp that says you have to be debt free, right? Because if you're debt free, especially in this time, when you look at the banking industry, when you look at interest rates and the economy, inflation, if you don't have assets, you're gonna get killed, man. Like you have to have assets that can keep up with inflation. So Million Next Door is a good read as an entry level. Maybe even Richest Man in Babylon. That's another good one that I really like. Real easy to go. Rich Dad Poor Dad. I think if any of your listeners are maybe in their early 20s or they're looking to just get started, starting with just changing your mindset.
Right.
Another good one is Rich Dad Poor Dad, Think and Grow Rich, and then you can go on to Million Next Door, and then the Cash Flow Quadrant, and really Think and Grow Rich is my top pick.
Those are all great books, by the way,
Yeah.
man. Think and Grow Rich. I've gotten to the beginning part of the book, and I'm trying to find the time. But that's one thing about like when you're doing all these things, you have all these moving parts. It's hard to really sit down and just read, right? So
Right.
I think you do some audibles, right?
Yeah.
Would you recommend doing audibles?
Yeah, and I think again, just I'm not the end all be all, but again, I think a lot of where I internalize what are my learning styles, with me having to train people in the restaurant and open restaurants, and just all of my background, I've learned about myself that I'm kinesthetic, right? I have to be hands on. I have to be engaged. Like for me to think and grow rich, one of the practices that I do is go on think walks, right? For me to sit down and just be still and have to like study something is very, very difficult. So again, I'll often go on a walk and be engaged and in motion, and then I'll think, and things just they come to me, right? But to your point about reading, yeah, I have a whole laundry list of dyslexia or comprehension or all the different things that could hold me back, but I'm choosing to be utilizing the tool like Audible, right? Go through those books, and I guess more of a technical standpoint, I'll listen to books and I'll run through them, but the ones that are like, oh, there's something here, like I need this book, then I'll go get the hard copy, then I'll get the highlighters, and then I'll kind of study it, like the Cash Flow Quadrant or Think and Grow Rich. And there's other books, like I really like Pitch Anything. Really good book on productivity and framing and how you can have interpersonal relationships. The one thing about being productive over being busy. And so these are, I guess, books that have really shaped who I am, but I wasn't able to really appreciate those, really take them to heart until I read through them once, listening to them, and then saying, "Oh, I want to devote some time to it." There's other books that are great and helpful in your self help, but not all of them are life changing, right? So to me, I use Audible to kind of get a preview of what I'm getting myself into, and then filter out what's as a top priority for me to go back and read different books. So yeah, I use both.
We're all wired for success, but we're programmed to fail.
Ooh, that's dope.
Yeah, yeah, man. So, what are some common misconceptions or myths about real estate investing that you often encounter?
That's a really good one. I think myths about real estate. I think maybe to apply just my own story again, like the small portfolio properties that I do have haven't had to use my credits, right? I didn't need bank approval. They're not being reported to the credit bureaus, and that's a reflection of me choosing to surround myself with the right people. And you can go to RIAs, you can go to different meetups, you can find people that can show you how to do this stuff. I mean, again, I hope your listeners are getting involved with your community and really being able to just find the right people to connect with. But the myth of like, I need money or I need credit or I don't qualify.
Right.
It's interesting to me now where the barrier to entry for me at the very beginning was like, oh, I don't have good enough credit, I don't have enough money, I can't afford something, I don't qualify, is now kind of the benchmark, right? So what before was, oh, I couldn't do it, is actually the standard of like, well, the next deal I do, I want to have a joint venture limited partner for the down payment, and then a DSCR loan, and I don't want to have to use any of my own money, right? I've
Right.
Previously I was negotiating buying a 100-unit portfolio in Central Illinois, and part of that was going to be a subject to transaction, and then raising the capital for the remaining portion, and really being able to offer my expertise and do the debt restructuring through equity acceleration. But all of that was in the works of being able to do creative acquisition and private money, and not any of my money, not any of my credit, not any, so again, like the thing that was holding me back before is actually the thing that I'm shooting for now, right? And so I think the myth that a lot of people are really kind of allowing to, take an effect on their mind is, oh, all the reasons I can't do something actually might be on the other side of it, your success.
I love that.
Right.
That's awesome, man. So I know you mentioned credit. Now, like I know you managed to tap into the business credit game. So, how have you successfully leveraged business credit to fund your real estate investments? And what strategies or tips would you share with the listeners who are interested in doing the same?
Yeah, and so again, I do like to approach the conversation as a practitioner, right? And a lot of what I do within Wealth Artistry, or that financial big brother, is here's the playbook, here's what I'm doing, as opposed to telling people what to do. Like, I'm a financial team captain rather than being a financial coach. And so with that being said, I've pieced things together in my playbook, right? So it started with buying properties out of state, or using my retirement account. And then I progressed into equity acceleration, and then infinite banking. And now business credit is kind of the latest flavor of what I'm incorporating and what I'm doing. And also getting into the nonprofit space and stuff because of what's happened back home. But to the heart of your question, business credits and tips. Recently, I started a new entity, new corporate structure. So going through the anonymity purposes of having a Wyoming company, and then having that company create a new entity in Kansas and Texas. I'll have one in Nevada, and I'm looking at doing one in Montana as well. So again, just beginning that process. But to really look at my experience with business credit, it is somewhat newer of all the things that I'm working on, but nonetheless, with a company that I created in second quarter, hasn't had any revenue come in yet, but leveraging my personal credit, being able to have the inquiries and do the personal guarantees. I've gone through my first round of that first tier of business credit, and I'm looking at three brand new business credit cards, two Amex and one Chase, that are the equivalent of about $68,000, right? And so now I'm approaching the next level. Like, I'm leveling up and I'm not just like saying it to say it. Like, I'm tactily, like, really like leveling up, because now I actually have a tangible resource. So I'm doing the balance transfer to go from the available balance on my credit cards to now my business bank account. And let's just say I got 50K in there. I can go buy a business. I can use a down payment on a property, right? So again, it's what I call stacking these advantages. You can play single advantages, right? In my mind's eye, wealth artistry really is like a strategic card game. It's like a multiplayer game of chess, right? Being able to think many moves ahead, but then also being able to play single advantages when you can, or stack those advantages. And, for me, it's like, I have a new entity where I'm going to get bonus miles. I'm going to have tax deductions, right? So again, you can start getting more impact out of the same moves as you start to, maybe ask better questions. And I would say, to kind of the business credit point, really looking at preserving or maintaining your personal credit and expedite that process. One of my existing company that I have that owns my rental properties, I did it the DIY way, right? So net 30 accounts, merchants accounts, really taking 6 to 9 months, year and a half, kind of going through all that process to establish my Dun and Bradstreet number, the Paydex score, things of that nature. But then also really being able to kind of do that in an accelerated fashion in this latest go of it. So really, I think the thing to be for your listeners, I think, would be, one, surrounding yourself with people that are in the space, that are doing it, and that can share with you how to do it, and not just an e-course, and not just a master class or a mastermind group, but finding people that are doing it, and really spending the time with them, right? Creating value for them. But the business credit it's not an equalizer, but it definitely levels you up to the playing field of where you need to be, right? Because we could, my own story, a quarter ago, it was me and my income, and my earned income, my employment. Oh, well, I have these portfolios of properties. Oh, I have this path of income, I have this stream of income. But now, a quarter later, now I've got, a tangible resource of 50K to go deploy, to go do gap funding, to, for some of your community, that's gap, gator lending, right? Or gator
Gator
funding.
lending. Yep.
So again, I can get into that space because now I have a tangible tool to work in my favor, right? To stack those advantages.
Man, that's awesome, man.
Right.
Utilizing banking credit, business credit. I mean, it's awesome, because then you have more tools in the tool belt, right? People think so small. It's like you can utilize these other tools if you know how to use them
Right.
properly, right? So with that being said, like I know creative finance and sub two is not like primarily your strategy per
Yeah.
se, but you and I know real estate investing, like the traditional way, it can be complex.
Yeah.
So, especially in today's market with high interest rates and such low volume of housing that's currently available on the market, are you pivoting at all? Or like what are some strategies for securing funding, especially for beginners?
Right. And I think to that point, the pivot to me is almost kind of the natural trajectory that I'm on, right? It's on the course that I'm already on, having kind of gone through the last few years, right? And so, really adopting what I've done with equity acceleration in my own portfolio, and then being able to share that with my clients within Wealth Artistry. The gist of what I'm doing in this market with Federal Reserve and central banking and the Treasury basically saying until we get more layoffs, until we get more unemployment, interest rates are here to stay, right? When we look at the perspectives of people that are just getting started and dealing with FOMO and, oh, I missed out, like, oh, interest rates were 2.5% or 3%, 4%, now they're 7%, 7.5%. I missed out. It's like, well, if you roll back the tape, like the people that have shown me everything that I know about real estate, they got into real estate at 16%, right? 18%, right? And these are individuals that have been 30, 40 years in the making, right? So again, it is somewhat relative when you think about interest rates and supply and demand. But I think the thing that I'm really emphasizing, the attitude I have is I'm making banking products that the bank won't give me, right? Now, what does that mean? Well, part of that is really accelerating my equity through my use of lines of credit, understanding where amortization is on a loan. And so to me, it helps having the equity from other properties. So again, if you're just getting started and you're a borrower and you're working 9 to 5 and you don't have time, you don't have resources, you're not bringing a lot to the table. Again, you have to work harder on yourself than you do your job, and then really remind yourself that your profits are better than your wages, right? And getting to that point where you might be limited, like we said earlier, but I think the pivot for me now, it's doing both. And I don't know if now is a good time to pull up the equity parlay method, but to me, it's on one hand, one component, it is utilizing creative acquisition, right? So many of you guys are probably familiar with subject to, you can do an installment sale, you can do private money, you can do seller financing. And so again, the acquisition is fine, but then again, in that interim on the hold, it depends on what you want to do. If you want to be short term and if you want to, fix and flip and do that, that's one thing. But when we're looking at the predicament that a lot of house hacking or burr consumers are looking at, it's the ability to refinance out, right? Now the interest rates are a lot higher. Now your debt service is higher and now your cash flow is lower. And so again, if you guys can see the screen on the left side of it, we're basically looking at applying creative acquisition and then coming into the mix of what I call equity acceleration, right? And so with the higher interest rates, they are something to be aware of and be informed of, especially if you're looking at working against time, right? So a lot of the moves I'm making right now, I'm really wary about balloon payments, right? If you don't know for sure that you're going to have a lower interest rate in the future, you might want to do what you can to not be obligated by a balloon payment. But what it really comes down to, in me parlaying the equity from one property into the next to the next, it's really keeping more interest from the banks, right? And so again, I'm hoping, Joseph, you'll have me back at some point and maybe we can do a deep dive on creative acquisition and within the wealth artistry context, as well as doing a deep dive on equity acceleration and really kind of unpacking the utility and the impact of what that can do for individuals. Because one of my clients right now, she's buying or she has bought, she's already closed on her second investment property out here in California. I previously helped her get her HELOC on the last property that she has. And just by converting $10,000 of principal from her new mortgage to her line of credit with equity acceleration, she is now effectively looking at saving about $55,000 of interest, right? Now that it doesn't show up in your bank account, doesn't show up as grocery money, But when we're looking at more of a medium to longer term game, all of that money is being kept in the family. It's not going out to a third party. It's not going to a bank. So effectively, every monthly payment that's being made, more that's going to principal pay down, and more that's going to be kept into the future purchasing power for you buying more properties for your portfolio. But really, for anyone that wants this resource that I have on the screen, you can reach out to me if you know how to get a hold of me, or get a hold of Joseph. And again, we can pass this along to you guys. But essentially, it really is combining, I think, a foundational piece of creative acquisition, which is, you know, game changing, right? It takes things to a whole nother level as far as, again, are you qualified? Can you do a VA loan or a USDA loan? Do you qualify for HUD or not, right? If you're being told by, you know, people that are know-it-alls or professionals that say, oh, you can't qualify traditionally or conventionally, well, there's many other options. You just got to get off that script. You have to find people that can structure the deals in a way that, you know, someone that might be conventional may not, right? I.e. subject to. But again, a lot of people are still leaving money on the table by taking a mortgage subject to, which again, I get right now. There's a lot of motivated sellers that have come from getting their mortgages in a historically low time, right? So 2, 3, 4%. But is that going to be inevitably for the future? Probably not, right? Because we're now getting to a point where people are doing what they can to, you know, get a mortgage at 5% or 6% or 7%. Those people moving forward, you know, if they need to move or you know, find a, you know, a buyer, really being able to apply equity acceleration in a higher interest environment is something I think another tool that more people should be doing, right? If you think subject to or creative acquisition changed how you do real estate, equity acceleration is a cherry on top of that, right? It takes it to a whole nother level beyond that. And then you get into infinite banking and a few other things too. So
Absolutely. So equity acceleration. So basically, it's not about being debt free. It's not about just paying off your house, even though you can apply that, right? You're just basically, you know, you're using one banking product as a tool against another product,
that
correct?
that is essentially what it is. And what I'll do occasionally on certain Saturdays is I'll do a presentation for friends and family and just kind of share exactly this, and we'll have open Q&As. And again, we can, you know, have another episode to really deep dive on this. But essentially what it comes down to, it's not me versus the bank. It's not me versus the mortgage. It's me having a tool, i.e. a banking tool, a line of credit card. You could look at cash savings if you wanted to apply it that way, against your amortization schedule, right? And so the big idea, it's changing the way you look at time, right? And I know that's kind of ambiguous. Like, what do you really mean by that? But I have a completely different relationship with time now than when I was conditioned or raised or programmed prior to knowing all this stuff, right? So the way that I can float payments, the way that I look at my loan to values is very, very different, because it's not me having to pick up more shifts at work. It's not me having to pay extra in my mortgage. Now, it definitely can help, but to really distinguish between some of the other camps and equity acceleration, it goes beyond just being debt free, right? It's a mentality that you can't go into a bank and ask for an equity acceleration account. They're going to give
Right.
you a funny look. They're like, well, what are you talking about? Go and beyond that, go into a bank and ask them, hey, I want a simple interest long-term loan. I'm not going to give it to you. And this is what I meant by I'm making a banking product that the bank won't give me, because I have my lines of credit in place, right? I have this growing equity. I have my loan to values. I'm deleveraging and all of the different things at play. So I'm coordinating this. I'm orchestrating the things around me. And so where I'm at, it's looking at the opportunity to go get a mortgage at a higher interest rate, qualify, do all the whole kit and caboodle, how everyone else does it, but then come in with my ace, play that equity acceleration card, and then essentially take a 30-year mortgage and have it paid off in about 5 years. Now, my results are not typical. I like to think of myself as above average and exceptional. had a really good cap rate on that mortgage, and it benefited from appreciation. But nonetheless, I think someone that is kind of in that conservative or moderate place of like, I work for someone else, I happen to have a property, maybe it's my own primary residence, and I'm getting kind of killed with these higher interest rates. Equity acceleration is more relevant than ever if you're, having just bought your house within the first year, and anything north of 5%, this is applicable to you right now. So you don't even have to be this fancy real estate investor, big shot person. You could be just a mom and pop, or just, single family trying to get ahead, make ends meet. This could be changing a lot of what you have going on for you, because you're using the banking tool against the banking product. And once you start seeing where, if every mortgage you get, you're basically buying two houses, you buy the bank their house first, and then you buy your house second. Let's change that, right? And I'll kind of say this real briefly: cowboy math, rule of thumb. Again, not financial advice, not legal advice, but really the way I look at it is I take the APR of whatever I'm quoted, right? So again, if you don't mind disclosing, or if you want to make up a number, what would be an interest rate you're looking at for the property that you're buying?
The one I just recently acquired,
Right.
4%.
Right. So 4%, we're looking at, in my cowboy math, the total cost of interest is approximately about 80% of whatever you borrow, right? So
Right.
again, the rule of thumb is if you got a mortgage and you're quoted a 5% APR, essentially you're going to pay 100% of whatever you borrow in interest, right? This is how the game is quote unquote rigged. This is how it's tilted in the bank's favor. And I'm not here to, say, oh, the game's rigged or boo-hoo anybody. I'm just saying, if you don't like your seat at the table, go sit on the other side, right? Listen to these, go do what you got to do, take action, and then go sit on the other side, right? But again, super powerful strategy for people that are buying properties in this environment that may or may not necessarily be subject to, but really being able to make the most of the banking side of things.
So you're saying you can basically take a 30-year loan and chop off 25 years? Is that what you're saying?
That's not what I'm saying they can. I'm saying that's what I did. So yeah. I think the reasonable expectation, though, I really want to just maybe say, let's just call it 7 to 9 years, right? For someone that isn't as versed in how to use leverage or how to use debt to their favor, I think a reasonable expectation, again, it's going to fluctuate case by case, because again, everyone's interest rate is going to be different. When do you apply this mortgage, right? Or apply the strategy to your mortgage, right? So one of my clients, he had a 5x return on his effort, right? So we looked at his converting of his principal and all that, and he basically saved 5 times the amount of money he converted in his principal. And he's a stock market guy, right? He has some real estate properties and he's looking at in the stock market, and he was like, where else can I get a 5x return with very, very low risk, right? It's a matter of guaranteed. It's just on paper. And so he's at a point where initially he saved 5x the amount of money he put in converting the principal, but it's going to be based on his situation where he had a brand new mortgage month one at 6%, versus, let's just say, another property that he had for maybe 3 years, and that might have been at 4.5%, right? So again, we can choose which one's more impactful. Oh, well, let's do the one that you just bought at 6%, because that's where all the interest is, and you haven't done the damage yet, right? The other property, he's already paid the majority of the bulk of that interest already. So it'd be more useful as a mentality, as a strategy, to apply it to this property. So again, I think a reasonable expectation, 7 to 9 years. If you get an exceptional cap rate and you have a good cash flow and you're low vacancy, then sure, it can happen. Like for me, like I was able to pay it off in about 5 years.
So why do you think equity acceleration is not more out there, like more commercialized? Like, to me, I never heard about it until I met you.
Right.
Is this something you made, or is it something you
No,
created, or is something you learned about?
I would say, and I like the question, and to me, it's like this is my own spin on it, right? And so it goes by many names. You can look up a sweep account, or the pill method, I think, is a variation of it. It goes by velocity banking. there's many different ways that you could look at kind of the differences between our banking system and maybe other countries' banking systems, right? So you go to South America or Central America, you go to Australia, you go to England, they may not have lines of credit, or they may not have a credit card in the way that we know it, right? They may have different formats of finance, but the main point, it's really looking at, or within the wealth artistry space, my spin on it is wherever you point your eye, like when you do action sports, you're outdoors, wherever you point your eye is where you're going to go, right? And so again, this isn't just being debt free. Like a lot of the conversation, which I think we can make some time to come back for another episode, is to not just be debt free, right? My attempt in sharing this with you or anyone else is to graduate from being debt free, right? Really be able to use leverage or debt effectively so that you can continue to play the game and create wealth in a way that is appropriate to your risk tolerance, right? So, yeah, so I think really it's not as common for a couple different reasons. I think there's different layers to it. I mean, in my own experience and my one-on-ones right now, like the last 3 people I've talked to that I'm walking them through this process, no joke. I tell them, okay, this is what you're looking for. You're looking for a line of credit, a personal line of credit, or we're looking at getting you a home equity line of credit. No joke. They have the conversations, and obviously I'm not doing it for them. So I'm kind of like send them on their own,
Right.
cheering them on. You can do this. Okay, I had the conversation with the representative or the specialist. Okay, we got all the loan docs, and I'm like, all right, let me take a look at it. Let me review it. They had a whole conversation about them getting a line of credit, and then when it comes time to sign the document, it's a loan. So again, I don't know if it's intentional or they're unknowing, but again, a lot of the individuals at the banks that really provide these resources or these tools, maybe they just don't know. In my own experience, every time I've asked for a line of credit, they're like, oh, I'll get you a loan application. It's not as familiar from the professionals in using these products. And I think it is kind of presumed to being more of a corporate thing, a Fortune 500, like if you have the Coca-Colas and the Fords, if you have these big companies, the Walmarts, they all have a sweep account, right? It's essentially an overdraft account. So again, it can go by different names. It can, like a line of credit is referred to by many different terms. But equity acceleration speaks to, again, using your line of credit to convert the amortized principal in your loan into simple interest. And then by doing that repeatedly, then you can really change a lot of the outcomes of how much interest you're going to wind up paying.
I agree, man. With that being said, you brought up a good point. I really like the idea of bringing you back and getting more in depth and more parts of it, like creative acquisition and the whole parlay method. And if you're open to that, let's
Yeah.
bring you back and let's do a series on it. You
Yeah,
open to that?
I'm definitely down to do that.
All right, absolutely. All right, man. So I just want to kind of ask you one last question before we close this thing out.
Cool.
And that would just be, if you had one single advice you can give to someone new that's just starting out today and just feels overwhelmed or not quite
Mm.
sure how to begin, what would that be? What would that advice be for them?
Kind of putting me in the hot seat on that one. I think if I had to put it into one term, I think it would really look at being able to fail forward and fail fast. A lot of what I do as an entrepreneur, as an employee, somewhere in the midst of that, is learning how to do things. And I think a lot of the younger guys, a lot of newer people to real estate are really risk adverse. So finding a lane for you to stick in that feels okay, where you can strategically take a calculated risk, get in your discomfort zone, come back, right? Take a graduated perspective, because again, you're not going to be able to know it all. But again, really, I think adopting, I think the done beats perfect attitude is really, I think, an economic, or not an economic, but a driver in my life, right? It has really prompted me to move forward, whether it's, doing some of this type of stuff, like being online and social media and being able to share some more content. Is it buying a property sight unseen out of state? Is it applying for a mortgage and my heart's like, what did I just do? Like, I have all this money on the line or whatever, right? So again, there's too much for one person to know all that there is to know, or all the things that there will be. But if you can really, I think, take the heart, really, done will always beat perfect. And I tend to overthink things. And I think there is a lot of people that are dealing with what's called analysis paralysis, right? Preparing to prepare, learning to learn. And equally true, shiny object syndrome, right? So again, maybe you're not just getting started, but you've been at it for a little bit and you've got, some, accomplishments under your belt. But then you're going from this thing to that one, and just getting nickled and dimed, and not really having the success that you really want, right? You might be able to have some experience. And again, whether you're just getting started and you're like, I don't know where to start, or you've begun and you're just not really getting what you want, a lot of that, just for myself, has been alleviated, or at least put into check, because I've been really focusing on what's the one thing that by doing that, everything else is inconsequential or unnecessary, and really being able to block my time and challenge myself in a way that is, not making any excuses. It's finding solutions, asking myself how. I think would be another honorable mention is like, done beats perfect. But then when you're faced with these challenges or these lessons, or failing, the question I always ask myself is, well, how could I do it better? How could this be done? Who do I need to talk to? Right? It's really being able to engage my mind, and actually thinking. It's not being what you need to think, it's learning how to think, I think, is really the deciding factor for people that can venture out into the unknown, be an explorer, be an entrepreneur, invest in real estate. I think a lot of that really comes down to, again, whether you think you can, you think you can't, you are right. It's whatever you set your mind to, you can go do it.
No, that's all great advice, man. All great advice.
Gotcha.
With that being said, let's go ahead and wrap this up. But
Cool.
anything else you want to add, or would like to, our guests to know about, or where can we
Yeah.
find more about Wealth Artistry?
Yeah, no, and I appreciate the highlight on that. So again, Wealth Artistry, I'm on Instagram. You can look up my business page on Facebook. I do have a website, but again, it's a work in progress. So if you can find it, wealthartistry.com. But majority of the way that people get a hold of me, get on my calendar, get involved with my small groups, is going to be through my Instagram, direct messages, or if you want some more of the content, some of the freebie stuff, Wealth Artistry on Facebook is a great place for that. And I will say again, just looking forward to the future, again, doing more scouting trips and field trips for my future executive clients. So I have my base camp of my online small groups, my graduate group, and then I have my masterpiece small group mastermind for my clients. But for any individual that might be a little bit more established and looking to expand into other markets, I just want to throw that out there. Me and Joseph, we're going to Dallas to go look at his property he bought subject to. We're going to do a deep dive on the path of progress, the no-go zones. We're looking at where are the areas that he should be buying his next property. So again, I think a lot of the things that I'm doing connect on my social media, and then really being able to see if you'd be a good fit to being a member on my online small group, or one-on-ones, or maybe an executive client, and just kind of going from there. But yeah, Joseph, can't thank you enough. I do think that you are, like myself, above average and exceptional. And I think, again, a lot of, if I could just speak to your character and who you are as a person, and the reason I'm choosing to support you and really do life with you is, again, really looking at who you are as a person, and living your life well, and doing the things that you do, and frankly, don't talk about it, but be about it, right? You have that ability, or you have that, essence of who you are. So I really appreciate you, offering and suggesting for me to join you on your podcast, and allowing me to kind of speak on some of these other things, because I have a servant's heart for, the people that are financially illiterate, or that are, wanting to graduate from being debt free, accelerate their equity, pursue financial mastery, right? So these are all the things that I think where we're connecting on.
Absolutely, I agree, man. I definitely appreciate the shout out as well, man. It's been a pleasure having you, Reese, and looking forward to those future podcasts with you, brother.
Yeah, we'll get it done, and I'll see you here shortly.
We'll be in Dallas.
Cool. All
All
right.
right.
Peace.
All right.
Bye.
Good seeing you, brother.